Welcome back to Industry Insights exclusive interviews. I'm Julie Miecamp. This is the show where we go beyond the headlines, where we sit down with the people who have actually done the work, built the practices, been in the rooms where the decisions got made, and where we ask them to tell us what it was really like, not the version for the press release, the real one. Before we get into it, please note that the views expressed in this conversation are those of the speakers and do not necessarily represent the views of Octus or its affiliates. This episode is for informational purposes only and should not be treated as investment, legal, tax, or financial advice. Nothing in this discussion should be understood as a recommendation to buy, sell, or hold any security or pursue any particular investment strategy. Listeners should rely on their own judgment and consult their own advisors before making investment or business decisions. Today, we're heading into European private credit, and the timing on this one is sharp. Everyone is arguing about the same handful of things right now, and this conversation walks straight into all of them. If you have watched European credit evolve over the last 2 decades, Mathew Cestar has been somewhere near the center of it. He started in the financing group at Goldman Sachs, spent 15 years at Credit Suisse, where he rose to co-head investment banking and capital markets for the region, and he helped build the leveraged finance business in Europe back when the public markets were really the only game in town. He later ran symbiotic growth as CEO, advised the top of the house at ICG, and today he's president at Arini, a firm built deliberately around the idea that public and private credit are converging into a single market. Lucia Camblor sat down with him at a moment when the whole industry is debating a software reset, the threat from AI, and whether private credit has quietly gotten ahead of itself. What I appreciated about this one is that Mathew doesn't do the panel version of any of it. He will tell you Arini walked away from software lending 18 to 24 months ago, before the reset everyone is now scrambling to explain. And he pushes back hard on the panic. In his read, the real near-term pressure is not the AI headline, it is the cost of capital and the wall of refinancing coming due. He is blunt that the private markets have gone years with almost no restructuring, while the public markets restructured every single year, which tells you the default are still coming. And he makes the case that in Europe, the winners are the managers who do the boring work, the legal underwrite, the insolvency analysis, real diversification rather than the tourists chasing the same crowded trade. Bigger, he says, is not safer. Here is Lucia Camblor, Deputy Head of Private Credit and Deal Origination at Octus, with Mathew Cestar.
I'm here with Mathew Cestar, President at Arini Capital Management. Mathew started his career in the financing group at Goldman Sachs before spending 15 years at Credit Suisse, where he held a series of senior roles in EMEA leveraged finance and credit, ultimately serving as co-head of investment banking and capital markets for the region. He then served as CEO of symbiotic growth and most recently as senior advisor to the CEO and global head of credit at ICG before joining Arini as president. So Mathew, thanks for being here.
Lucy, it's a treat to be here. I follow the podcast, and so it's great to have the conversation. And yes, I've been in Europe a long time, so hopefully I'll unpack some of the story in today's conversation.
Maybe actually we can start with the landscape. How are you seeing the European landscape for private credit at the moment?
Yeah, well, maybe a little bit of a history lesson. The European credit markets have really fueled in large part since 2008, since the GFC. And that's when you saw this explosion, both in the public markets and the private markets. And so the shape of the market has really developed really over the last 10 years or so. Of late, what you've seen is, meaning the last couple of years, is really this growth in sponsor-backed financing, large cap sponsor-backed financing. That was the main area of focus as these markets grew when rates were low and there was a lot of credit creation in Europe. I think what's happened of late is now everything that sat on the bank balance sheet. So not just corporate credit, but ABF or asset-based type lending, real estate type lending, and the rest of now coming off the bank balance sheet in scale. So the landscape here, when people say private credit, it's many different things. And I think that's a good thing for investors like ourselves. And I think it's a great opportunity set for a lot of the pools of capital who want to allocate to Europe. And so they can look at different risk-reward profiles across the corporate landscape, across this asset-based landscape, across real estate credit. They can look at performing credit and more stress and opportunistic credit. So there's a lot to talk about. But what I'd say is the most recent movement in these markets is really this one of diversification and scale.
Mm-hmm. And maybe let's bring that also into sectors, because not all parts of private credit are exposed the same way. Technology, and particularly SaaS, had been considered a resilient sector. We have actually here some data from Octus that says that software-related borrowers held the largest portion of direct lending activity, with 42 deals completed in Q1 of 2026. Now, with the potential disruption of AI, we are hearing about valuation pressure, some slower growth, and some potential stress for some of these businesses. So we have a macro shock and a sector-specific reset in SaaS happening at the same time. So have you changed your lending strategy?
Yeah, so this has been a longer story, which is the regulatory change really pushed a lot of the lending, the highest leverage lending outside the bank system. And it was really the private credit markets that embraced that, first in the US and then laterally in Europe. And as you said in your comment, it was perceived to be the safest area. But a lot of these so-called safe areas become overcrowded. And what you found in the software space in particular was so much activity in the private equity space, and the second derivative of which is all the credit that supports that. So a lot of concentration in a single sector. And so a natural weighting would have been, who knows, 10, 15% of the portfolio grew to 30, 40, even 50% in some of these portfolios. And I think that's a reaction to what happened with the regulatory landscape, pushing this very high lending outside of the regulated banks, but it created an enormous problem for private credit. And what you've seen is really over the last, what it's been kind of 12 to 15 months, all the pressures that you talk about, which is the lack of exits in this space, the concern about disruption from an AI perspective, have put this area, tech and software, in focus. For us, our own view is, we're credit managers. So we're focused very much on the downside, and you're really focused on diversification. And what you found is many of the credit managers kind of lost those very basic skills, to be candid, which was they overrepresented a sector which they thought was very defensive. And because it had high free cash flow, because there were high amounts of subordination beneath the lending activity and equity or subordinated type credit, and because it's really this growth area that was a derivative of the private equity markets. So there was an overallocation to that marketplace. For us, we had exited that for about 2 years ago. And that was really informed by some of the public capital markets activity we saw in this space. We look at this converged credit market. The private markets and the public markets are really serving the same types of companies underneath that. But we saw this lesson very early because we were on about half of our capital at Arini is public market strategies. And we just saw how there was such a crowded trade around software lending to sponsors in particular, that those capital structures were really priced for perfection. So very, very high leverage, very, very tight coverage levels. And given this sort of the intersection between the public markets and private markets, many of the sponsors were able to remove a lot of the credit protections from those agreements, covenants, for example. So we saw that happening in the marketplace and saw from a risk reward perspective, that wasn't a good place to lend. So for us, private markets, but also in our long businesses and our performing businesses, we don't have any credit exposure into software. And so it seems a little bit self-congratulatory now, but this is something we moved 18 to 24 months ago. To your question, it feels like a lot of folks are focused on the AI disruption, and it's unclear which businesses will be disadvantaged and which ones will actually be advantaged. And I've seen a bunch of managers talk about, my portfolio and you segmenting the portfolio based on likely disruption. I think everyone's willing to admit it's probably too early to know. The technologies and the releases are happening so quickly, it's really hard to know what the disruption is going to be specifically from AI. But what we do know as a credit manager is the cost of capital, in many cases, almost doubled in terms of those software-related companies. And so if you look at the credit contraction, the amount of capital that's pulling away from the system will create very significant refinancing risk for these companies. And if these were companies that were priced for perfection, peak leverage, many of which couldn't support the cash leverage levels, they have to have, started with PIK day one, you'll see that they will not be able to support the same leverage levels in the new rate environment. So we're watching the AI space very, very closely to see how it disrupts companies. But I think that the more realistic and nearer term pressure is really on the cost of capital and the contraction. We were just talking as we began at another conference I was at recently, and all the private credit lenders were saying, I don't do software, I don't do large cap lending. And obviously that's not the case, but it speaks to the fact that there's a big contraction happening. Yeah. And so if it's 30, 40, 50% of the portfolios, it's going to be an area of, quite a bit of refinancing risk. And so those are the reasons why I think there's real pressures in that system, less so about the AI specific risk.
And would you say that you have turned also more cautious overall, or is it more selective than that?
Yeah, if you dial out a bit, there's a lot of noise in the system. Yeah. Some of it's around this topic, AI, software disruption, the amount of credit creation that happened there. Remember also, just as a side coda here, in credit, you're trying to get your coupons and get your maturity, get your capital principal back at maturity. You don't have any upside convexity. Our view is software technology in the main is more of an equity-related risk. In credit, if you get it wrong, particularly for these asset-light businesses, and if you look at the recoveries from the agencies, they tend to be very, very small. There have been a number of very kind of high-profile traffic accidents recently, and just reminds you again that the recovery value tends to be quite low. So that's one thing impacting the marketplace. Two is, I think there was maybe 12 months ago or so, there was a sense that rates were going to step down again. I think that's now just been dispelled. We find European rates are actually in fact going up. So there's this whole dislocation around higher rates for longer. And I think that's going to put pressure on the marketplace. And if you look at the maturities that are happening in really 28, 29, and 30, they're very, very material, not just in the corporate world, but in the real estate world and some of these other asset classes. So that will create a lot of volatility. So there's a sector issue that's happening with software.
Yeah.
There's a rate environment issue, which is very, very material, we think. We only have to dial back to 22 to remember when there is rapid rate increases, and not that I'm expecting that, but when there are rapid rate increases, it really can create dislocation, particularly in the public markets. So I think those are two things that we're very focused on. And then the third thing is this energy story. Every time you think the energy story is a quiet one, there's new news flow out of the Middle East and the rest. And so I think there are a lot of risk factors that are coming down from a top level onto the marketplace. And so for us in this business that we're talking about today, we are at the top, we're at the senior part of the capital structure. We're not doing subordinated debt. We're not doing PIK. We're looking at lots and lots of opportunities and being very, very judicious as to what we invest in. So that speaks to a market where selectivity is really, really important, where domain expertise by industry. We at Arini have a very big research team, our sector analyst team, that has domain expertise in a whole variety of industries. And so navigating this kind of backdrop with a sector overlay, we think is the key. It always surprises me in Europe, and I've been here for about 25 years, most of the credit managers tend to be generalists. So one day they're underwriting a consumer deal, next day they're doing a software, the next day they're doing a chemicals deal. We think there's a real value in having domain expertise by sector. And so I think that's another way you can navigate parts of the capital structure. The other thing is on credit, again, you're trying to get that principal back. You're trying to make sure the cash flows are robust. We're not supportive of putting PIK into these balance sheets. And that just presages that you needed growth in order to support the debt level. And I think there's a general recognition now that, there's so many disruptors happening on the macro side, some very specific in the software side, that doesn't make that very prudent anymore. So we've stayed away from that as well. So a long way of saying, yes, this is a dangerous neighborhood and you have to be awfully careful as to what you do. What we find in Europe also is this is an environment where it favors firms like us and a few others that have domain expertise in Europe. It's not a place where you can kind of just step into as a visitor, because what you find in Europe is there is twin things you need to do in order to underwrite well. One is you need to be able to understand companies and their sectors and the cash flows, which is kind of credit 101. But equally importantly, you have to do a legal underwrite. What we find is many of the tourists who come into our marketplace, meaning kind of non-European investors, they might like a company in Germany or France or Italy, but they forget to do the legal analysis, the insolvency analysis up front. And that's what we do. It's kind of regular course. And so by doing good underwriting activity on the credit and then looking at the legal underwrite, the risk on the legal side, insolvency regime and the like, and looking for enhancements to that, that's the other way that you really kind of mitigate some of the risks that sit in the marketplace. And that's how best to navigate, in our judgment, Europe.
Yeah. And would you consider actually lending to a software company or how does it need to be?
Yeah. So I think there's, again, for the reasons that I said, is that there's so many pressures on the sector.
Yeah.
There's a lot to unfold. There's so much refinancing risk.
Yeah.
There's so much credit contraction that's happening, and the risk reward is simply not there. What we do in this business, and again, we have a whole variety of businesses at Arini. We manage capital across liquid businesses, structured credit businesses, private businesses. I think we're double clicking on private here today, is that we're generally financing what we call the real economy in Europe. Software and IT in the main are relatively small, which is a different discussion, which is there's not as much equity value creation in Europe, certainly as versus the US. But from a credit perspective, it's a small sector. And then for the reasons we said just a moment ago, we're not financing at all that area. Interestingly, many of the sort of non-US large cap investors have taken their US model and then taken it here. And they've over-amplified a lot of the software type activity. So in their US portfolios tends to be 30 to 40% software and related, and in Europe, the same. But that's a threefold multiplier here in Europe. So we tend to do more sort of European real economy. Yeah. So it tends to be manufacturing, hard asset businesses. We do some consumer. We do some services. But credit, where I think people got it wrong, was it's a business of diversification. And so we've been very deliberate to be lending across Europe. Stronger emphasis on Northern Europe, but across all of the EMEA landscape. So you get good diversification. Yeah. Sounds like an obvious point. But what you find is, again, from the peer group, if you're a London manager, you tend to have 50 to 75% of your portfolio in the UK. If you're a French manager, a Paris-based manager, again, 50 to 75% in Paris. And we think that just adds too much country risk. So we're very much focused on doing a pan-European approach. Similarly, on a sector basis, sort of reflecting the real economy in the middle market is where we spend our time.
Also, let's maybe shift from
Please.
deal origination to portfolio management.
Yeah.
How have you been seeing default rates, at least in the surface, look relatively contained? Are we actually seeing stress building beneath the surface?
I guess there's because we have this, we're driving convergence as a firm between public and private.
Yeah.
We're very cognizant of what's going on in the public markets. The public markets last 3 to 4 years have been restructuring kind of 3 to 5% every single year. But if you look across in the private markets, there's been no restructurings. Mm-hmm. And so it doesn't make sense because they're broadly similar companies. And so what it tells you is there's been pent-up issues happening in private credit. So we do expect that to unfold in the coming period. So we'll see an uplift, I think, in these defaults, particularly in the private markets. Because again, same underliers, same countries, same companies. And what you'll find is it will catch up with the public market. It's just a general comment that we have, which is, the public markets are always reflecting underlying performance on a daily basis, on a weekly basis, on a quarterly basis, because the prices are moving all the time. Agencies are also moving all the time in terms of reviews. And so what you find is the feedback loop in the public markets is very fast. And that adds more transparency and more dynamism, I think, in the markets. In private markets, heretofore, it hasn't been the case, right? So the feedback loop is 8 years later, 7 years later, when you're trying to exit your positions. And I think that's why there's been some pent-up pressures on the private side. What we do is we take a lot of the risk management skill sets that we have from the public markets and we're employing them on the private side. So approaching it in that sort of dynamic sort of way. And so, that's how we're mitigating that risk. But yes, we very much see an uplift in defaults in private markets. Again, small history lesson because I've been here forever. The lion's share of the growth happened when rates were zero in Europe in the private markets. This is also when the high yield market ballooned in size. So tremendous credit creation when rates were very low. If you remember, sovereigns went negative. The high yield market was yielding 3%. And high yield market, when it was 3%, ballooned about eightfold. Then there was this big growth also at the same time with private credit. So a lot of these early movers in the business have imported, we think, a reasonable amount of credit risk. Because if you're lending at 10%, which is what private credit was lending, high yield is lending 3%, there's a bit of adverse selection. So it's all catching up with the system. And so we're not expecting some cataclysmic sort of problem, systemic problem, but I think the defaults which have been underrepresented in private markets will certainly step up.
And everyone seems to be talking right now about private credit, and we just talk about the so-called SaaS apocalypse. But ultimately, private equity owns these businesses. So where does the risk stand today? With lenders or with sponsors?
Yeah, so I would just, again, the first principle is who has what risk profile. So in private equity, you have this convexity or upside. It's not capped, right? In the credit markets, it's capped. You're just getting your coupons and trying to get your maturity back and you enjoy all the downside. So it really depends on where you sit in the capital structure. The portfolio construction issues are very dissimilar between the two. Credit, in our judgment, should be very diversified by country, by sector, by borrower type. And that, to our earlier conversation, is the problem with the software space. People forgot that you shouldn't have that much concentration. No one anticipated the AI. Maybe they should have anticipated how stretched those capital structures were. They were the most tightly priced, the most highly levered, the ones that didn't enjoy any credit protection. So that was an early warning signal that we picked up at least. But running 30 to 50% of your portfolio in a single sector in credit is dangerous. Unlike in equity, perhaps. And again, this is not my business. I don't do this day to day, but as an outside observer, and I'm sure you talk to all the crowd as well, you can have a few losers in the equity side because you might have a 3 or 4 or 5 times winner and you can offset those losses. And so I think that's a dynamic between the two communities. I think the other thing that happened was software was perceived, why there's such anger around this whole topic from the LP community and the funds that are allocating it, is that software was pitched to be safe, recurring revenue, high margin, strong free cash flow, and the like. And so it was a safe haven. So instead of being, again, who knows, 8-10% of the portfolio, was amplified to 15%, 25%, 40%, and then it wasn't safe. And so that's some of the issues. And so I don't know how it's going to unfold on the equity side. I think it's, again, the risk profiles are very dissimilar.
Yeah, definitely. Yeah. And also, how are you seeing demand for private credit evolve right now? Because private credit as an asset class has performed well, but over the past 12 months, and especially more recently, we have been hearing about potential raising concerns around high-profile defaults like First Brands and being the end of private credit as we know it.
Yeah.
So do you think these are isolated events or signs of a broader shift in the market?
I think a couple of things are happening. So one is in private markets, it's really been a U.S. phenomenon to date.
Exactly.
So the 20-year head start, 25-year head start. What we're finding from our clients is it's not this push away from the U.S. It's incremental capital should find a new marketplace. And they're looking for one that has a strong regulatory framework, strong legal and insolvency frameworks, a lot of transparency, and high-quality companies. And so what they found is that 80 to 90% of their exposures in the U.S., both in equity and credit in the private worlds. And you look at the relative size of the economies or relative size of the opportunity sets, I don't know, it should be 60-40, 70-30, something like this. And so they're finding they're just overexposed to the US. And the exposure, it's not a political comment, it's not an emotional comment, it's a returns comment. Returns have been compressed, leverage has stepped up, and they're looking elsewhere. And so we've been a very large beneficiary of that, which is we can show that, Europe is highly diversified, particularly in the middle market segment, which is really what is the back of Europe. And the risk-adjusted returns are very attractive. So LPs, pools of capital, whether it's insurance, pension, endowment, foundation, sovereign wealth, are looking to rebalance portfolios. And that's what's been the movement, into this. And so into this marketplace, specifically in Europe, which I think continues sort of unabated. A product, in my own judgment, works well if it solves the return needs of the client, meaning the endowment, foundation, pension. They're looking for higher yields. They're looking for stability, and they're looking for durability of return. But also remember, on the borrower side, you need to have a product that's really meeting the needs of that company, family, individual. And what you find in Europe is there was never this big love affair with the public capital markets. And I've done this for a long time and grew the leverage finance businesses in the early part of my career. And most European companies are family owned, oftentimes multi-generational. They don't want to share their private information with a sort of a anonymous group of lenders. And so when the banks were pulling back quite quickly, there was this movement to the public capital markets because that was the only thing available. Private credit oftentimes is a better solution. It's more tailored. It's not cookie cutter. It's confidential. And it could be much more of a kind of a tailored solution. And that's why I think it grows and continues to grow, particularly as institutional capital comes in to make it a durable financing source. So this wasn't just a response to a regulatory change. There's a 3-year life or 5-year life. I think large investors believe that just given the U.S. experience, 25 years head start, we're very much on that journey now in Europe. So I think it's pretty durable. And I think it's from both constituencies, the investor community, the allocator community, as well as the borrower community think it's a nice solution. And that's why it's scaled. And the numbers are different. I think it's probably $1 trillion marketplace now alone in Europe on the corporate side. And what you're finding, as I said, was anything that sat on the bank balance sheet historically is now coming off this very highly levered bank balance sheet and getting done on institutional capital. And that's why you're seeing the growth in these key adjacencies. So adjacencies in the ABF world in particular. Europe doesn't have large securitization markets, public securitization markets. And what you're finding is European companies tend to run just heavier balance sheets. And so with banks pulling back from this, that's a very natural area also for investors to enjoy stable, higher returning stable returns from an asset, a real asset. And so that's kind of the next stage. We'll see the very similar thing that's happening in real estate credit. So European banks have been very long at the wrong price with a lot of their lending activities, and they're pulling back, particularly as the refinancing cycle upticks, not dissimilar from the corporate world. So that's again in 28, 29, and 30. And what you'll find is the lending levels will be reduced from the banks, and there'll have to be an entry point for institutional capital. And you can see that's a natural extension.
Yeah, and actually we have seen how, as you were discussing, how banks have been displaced by private credit funds in certain situations. Where do you think private credit funds are gaining ground, and where do you think banks still have an edge?
Yeah, I think so. It used to be the dialogue was like the banks versus the private lenders. Yeah. It's very much not like that. It's a very healthy ecosystem where each one plays in its relative strengths. And so as the banks have been deleveraging in many cases and reducing single name exposure, they've enjoyed, from a regulatory and capital perspective, portfolio lending. And so they've been playing our world by financing a lot of these portfolios. So providing back leverage. And so those highly diversified lending, granular, diversified lending portfolios, they're financing those. So that's a great way that the banks continue to work very closely with us. The banks also are desirous of keeping connectivity with these middle market companies and provide higher margin type products. So they very much want to do the M&A product, for example. They may want to do the cash management product, things that don't suit our interests that well. Equity markets have been more challenged in Europe, but they still want to do, if there is equity type activity, they still want to do the ECM and higher margin type activity. So I think we're just taking off that piece of capital from the banks that was not favored well from a regulatory perspective, and symbiotically kind of working very closely with them. Banks also, they trade with us, provide great ideas. I think there was a time when it's us versus them, and that's I think a very false narrative.
Mm-hmm. And we have also discussed about sponsor-backed deals, but you also do a lot of work on sponsorless. How are you seeing that environment at the moment?
Yeah, so we deliberately focused in this middle market space in Europe. One is we have great relationships with large cap sponsors. We service them in different businesses that we have, including our structured credit and CLO business. But in this private credit space, it was simply too competitive. Not from getting access, but when you look at the underlying deals, leverage levels are creeping too high, spreads were being compressed. And again, we're very focused on the credit documentation was being diluted very, very sharply. So we're very much focused on the middle market. And for us, that means middle market sponsors, which have a very different approach. They tend to be ex-industry executives, ex-operating executives who are teaming up with families, usually on a country-by-country basis. So they're not the global scale private equity firms, but they're ex-executives who have a fund who are looking to team with partners. So we find that a very rich area. Mm-hmm. They need our financing solutions. The other area is the classic, the non-sponsor, and truly non-sponsor. And we do a lot of that also because those companies have a huge financing need in Europe. As Europe gets a bit more financially or fiscally muscular, they're allergic to the public markets, a little bit suspicious of the large cap direct lenders that are out from outside of Europe. So they want confidentiality, they want speed, and they want a lot of thoughtfulness. The challenge for most folks has been, how do you access that? And so we do it in a bunch of different ways. One way is we use our own teams, the lion's share of which have their own relationships and they've been following companies. And the staff has been with us for a long period of time. And so which has been a very robust area to originate non-sponsor activities country by country. And then we also augmented it, and as we talked about just as we began, we augmented with a partnership with Lazard. Yep. We did that in a super deliberate way because their footprint is pan-European. They have great trust and integrity and super well known by non-sponsor families. These tend to be multi-generational families who want very tailored solutions, and it's hard to get access. Lazard wanted someone else who really had a set of financing know-how and sector knowledge to service those clients. So we came together to say, let's create a pipe, a way to service these type of clients. And that's really expanded our non-sponsor coverage. And so it's a scale, systematic way of accessing these mid-sized companies in Europe.
I actually also wanted to ask you about, we have seen capital rotating away from traditional credit into infrastructure assets. What do you think is driving that shift?
Yeah, so I think it's that theme that I talked about, which is institutional capital filling each one of these different areas, the corporate world, the ABF or asset-based world, the real estate world, and now infrastructure. Infrastructure used to be also the domain of the project finance teams at the banks. And I think what everyone is understanding is that when you take a business off the bank, you take something that's, 15 times levered, and it's a deleveraging event for the system, for one. So it's good for the overall credit environment. Two is once you move off the bank and without a lot of the regulatory headwinds, you have more creativity. And I think institutional capital, so the client business wants to get exposure to long-dated, durable, higher yielding infrastructure. And that's a theme that is playing globally. So you see it here in the EMEA region, you see it very much in the US, the Middle East, Asia. And so it's part of this debanking theme. It's probably most pronounced here in Europe, I think. Mm-hmm. Again, just as a reminder for everyone who's listening, the European landscape, about 80% of the companies finance through the banks still. Only 20% through the institutional marketplace. That's the exact mirror of the US. So in the U.S., it's only 20% of the activity comes to the bank, 80% through the institutional markets, whether it's the public capital markets, the large private credit markets, or the securitization markets. And so it's this debanking is happening apace in Europe. And I think infra is just another example of that. So it sat on the bank balance sheet. It was very consumptive of RWA and capital. There's a huge need in Europe for, it's not just digital infrastructure, it's transportation, it's is energy and the like. And so that's a major theme, and stay tuned on that for us. So I think it's just another expression of that same theme.
Okay. And also we touched upon the landscape on the top, but I want to come back on the macro backdrop. How are you seeing, because energy prices have been rising sharply, supply chains are under pressure. How is that macro shock impacting private credit markets?
Yeah, so I think cyclical businesses in Europe have been under pressure as a result, particularly in the larger cap size. And so what you find is the large cap companies in Europe have global connectivity, more integrated supply chains, much more complexity. They've been disproportionately impacted. We've been trying to stay away from that, doing broadly non-cyclicals. And then we've been really focusing on country by country champions. And what you find is they typically have local suppliers, local customers, and it's a bit more insulated from these global trade winds. But as we started off, I think the key three risks, the software risk is a very, very material one for the market, just given the size and scale. And this higher rate environment for longer, and there was a hope that the rates will come down, there'll be an easing of the pressure, it's all going to be good again. That appears not to be the case. We'll have to see, but it appears higher for longer is a very big adjustment versus the start of this year. If you remember the start of the year, everyone's expecting a whole series of rate cuts. So I think that's significant. And then this energy issue, hasn't gone away. So again, it was very heightened, several weeks and months ago. Who knows what's happening now as I read the newspaper real time. So I think that puts pressure on Europe in the main, and because Europe's short energy, that's a pressure that you have to be very aware of as you're underwriting. And again, at this business that we're talking about, this is senior risk. So it's the most defensive, part of the marketplace. And so that's the way to kind of dampen some of the risks that we see in the marketplace.
And also, we have seen this year that M&A has been slow, but we have seen some liquidity coming from secondaries and continuation funds. What do you think it means for the risk and return dynamics for LPs and GPs?
Yeah, well, I think there's two things. So one, M&A is fantastic. It's all-time great, north of 10 billion size. So corporate to corporate M&A is, I think it's the best year we've ever had. What we're seeing in the worlds that we're involved in the below investment space, because it's sponsor driven, it's been much more muted. Yeah, so I think that's going to be an issue. I mean, that's been the issue around DPI and the rest, and distributions to LPs on the equity side. And so as a response, there's been a lot of engineering how to create liquidity or extend funds and the rest. And so my own view is that shows real maturation of the market, of the private markets. You dial back a bunch of years, 20 years, it was a PE buyout marketplace. Now we have all these asset classes, and to have all these enormous primary markets, equity, credit, asset-based, real estate, infrastructure, you're going to need a series of secondary markets. So that's why that's growing, very, very quickly, both on the portfolio side and the so-called LP side, but also on the single name GP-led side, and then all of the new technology around that. So I think it shows a lot of maturation in the marketplace. And that's been one of the issues with the market, which is it's been, very stratified in terms of what you can do. And now with this new technology, there's quite a bit of stuff to do. But again, you have to be, whether you're an equity underwriter, credit underwriter, infrastructure underwriter, you have to be highly, highly selective, I think.
Yeah. And before we wrap up, I
Please.
want to do a few quick ones. Short answers, first thing that comes to your mind.
Oh, good. Here we go.
You ready? So, one thing you have changed your mind about in the last 10 years in the world of credit.
Interesting. Maybe this conversation that we just had, which is there was always a perception that large cap and size was more defensive. And it's actually on its head, which is large cap means scale deployment, or it means that terms are weaker, margins are tighter, leverage is higher, and it kind of turns your credit 101 instruction or lessons on its head. So I think one thing I've learned is that, bigger is not more defensive. You have to pick your spots very carefully. Maybe this middle space that we spend time on. And again, we spend time across all of our private markets businesses broadly in this same arena, whether it's the real estate world, whether it's the asset-based world, or in this corporate world. So that's kind of a nice thing that I've learned of late.
And one habit that has had an outside impact on your career?
Wow, one habit. I think it's dealing with adversity and being tenacious, because these markets are very volatile. The world is very volatile, and being persistent and tenacious in your personal life, in your professional life, is probably something that I've learned.
Okay. And the best piece of advice you received early in your career?
Wow. Best piece of advice early in the career: put your head down, be humble, be willing to learn. In this industry and many industries have lots of smart people, and they think they know everything. And what you come to learn is that you know not that much. And so being in a team or being in an organization that can have lots of information, being very humble with respect to learnings is probably the best thing. So lots of young people have all this confidence. I know everything. I think being humble is probably good advice for someone young in their career.
Okay. And maybe something you do outside work that makes you better at work?
Yeah. I mean, I have a big family and family is super important to me. And so finding a balance between work and personal life and devoting great time to my beautiful wife and kids keeps me, I think, balanced at the office. Yeah.
Great. And one thing young professionals in credit consistently underestimate?
They underestimate sort of the length of time and work it needs to get things done, I think. Sometimes there's a kind of short-termism, what's happening next week, next month, next quarter. And maybe apropos to my earlier comment is just putting your head down, trying to learn as much as you can and go from there. That'd be the comment on that.
Okay,
you asked some tough questions here. What else?
We will take it as an advice. And thank you very much, Mathew, for your time. I really appreciate it.
Lucia, it was a treat to be here. Thank you so much. And I'll see you very soon, I hope.
Yes.
Thanks so much.
That was Mathew Cestar in conversation with Lucia Camblor. The headline version of the private credit story right now is fear. Mathew gave us something more useful, a reminder that bigger is not safer, that the pain in software is really a cost of capital problem wearing a costume, and that the discipline a lot of people quietly forgot, diversification and doing the legal work, is exactly what carries a portfolio through. Clear, direct, and not the version you get on most panels. If this one landed for you, the Octus team covers private credit and European distress markets every single day. The analysis, the intelligence, and the data that makes conversation like this one possible. Check the show notes to go deeper. Follow us on LinkedIn and on X to keep up with what we're working on. And if you have a guest you want to hear on the show or a topic we should be digging into, send us a note at podcasts@octus.com. We read everything. A huge thank you to our producer, Tanya Hubbard, who makes this whole show possible. I'm Julie Miecamp. Thank you for listening, and we'll see you next time.